Live from New York City for our audience worldwide, Bloomberg Real Yield starts right now. From New York, we begin with the big issue, a messy week in markets.
All those moving parts.
It doesn't smell right. It doesn't feel right.
The CPI print yesterday was bad. It's really bad.
Inflation was supposed to be moderating.
Unfortunately, the data are pointing to a more systemic issue. You know, wage pressures are pushing into prices now.
Now it looks like we're going into extra innings.
As long as the data continues to come in strong and surprise to the upside, you're still going to get the market responding to this.
It is brutal.
This is presenting a real challenge for not only the Fed, but the broader economy.
We're in a situation here where we thought the Fed had made a one-off adjustment to get to the policy rates up to 4.75%.
I definitely think we'll see another 75 basis point move in November.
The question now that we all have to ask ourselves is a 4.75% policy rate, is that enough?
We're going to ask that question right now. Fantastic lineup to close out a week with TD's Priya Misra, ABRDN's James Athey, George Bory of Allspring Global Investments. First to you, Priya. Many people looked at that hot CPI and changed their call for the Fed. You didn't. Why not?
Well, we were already looking for 5% terminal. I think what's really tricky is that 75 basis points in November that was baked in the cake before the report. It's what happens in December. You know, we're calling for 50. I think at some point the Fed has to downshift. Even 50 is a lot, but going another 75, now the market's about 50% priced for a 75 in December. That's still a tricky one. But I think, I mean, the fallout from the UK, the fact that it's a less liquid treasury market, I think the Fed has to take all this into account. And if they get, and I realize is this a hope, but we are looking for some downshifting on the next inflation prints, and we've got, you know, 2 more before that December meeting, that the Fed does that 50. I mean, I think they can signal that they have more hikes to go. Maybe the terminal rate is 5 or higher than 5, but they don't have to go at clips of 75 every meeting. I think that's the messaging we need to hear from the Fed. So we didn't change our call because we were already looking for that 5%.
Priya, we'll talk about market functioning and liquidity in treasuries in just a moment, but let's start with the November meeting. How on earth does he do what you just said when we just had the CPI number we've just had?
I think he has to let the data do the talking. I think that November meeting, there's no dot plot. So at least we won't have another big revision. Every dot plot this year has had massive revisions. There won't be that in November. I think he does the 75 and then doesn't give any forward guidance. Forward guidance is anyway sort of dead. So I think he just says, look, we're data dependent. We've got 2 CPI prints. If there's any slowdown there, I think that's how the Fed then uses that to say, look, we're not saying we're done with the hiking cycle. We just don't have to go at 75 clips. But I think that's the messaging that'll come after the data rather than pre-committing to anything in November.
George Bory, you said higher for longer. How much higher for how much longer?
Now, as Priya mentioned, you know, the Fed is stuck in a position. They need to keep raising rates. And there's sort of 2 components here. One is kind of the peak, where are they going to get to? And then sort of how quickly do they actually get there? So that the timing, as you point out, John, you know, sort of a deceleration of rate hikes, that, in our opinion, it's not a pivot per se. It's a deceleration, and there's a meaningful difference. And as Priya said, there's a good argument that the Fed will continue to be in tightening mode as we get into the end of this year and into next, but they really don't need to go at such an extreme pace. That in and of itself, that would signal to the market that they're starting to get sort of control of the system, of inflation, of expectations, and importantly, of the bond market. You know, as just mentioned, liquidity is very thin. It's available, but it's thin. And that is sort of another major consideration that the Fed needs to contend with as we go into the end of the year. Typically, an illiquid time of the year, compounded with what's happening around us. And the Fed needs to be very, very sensitive to sort of the functioning of the market so it can actually implement its strategy.
James, how do they manage the message next month?
Yeah, I mean, that's one of the biggest challenges, John. You know, what the Fed has learned and correctly learned is that it can't be too honest about its expectations for future policy, certainly not months into the future, because the market will just leap on those indications and front run the response, and then you get a policy easing at exactly the time that you need to keep your foot on the throat of this inflation. So, you know, I agree with both the other speakers. I think that's exactly how it's going to play out. Timing is difficult. I think we're already seeing a few tentative signs that that conversation is emerging. The minutes this week had some participants already talking about the extent of tightening that's in the system and that's not really affecting key variables yet, but will do obviously with a lag. And I think that's the important part here. The correct steps in terms of policy to 8 or 8.5% inflation at 4 or 5% on the Fed funds rate are not really the same as when the Fed funds rate is only 1 or 2%. They've had to go quickly because they were so far behind the curve. They are less far behind the curve as we sit here, and therefore we can start to think about them just dialing down the pace of hikes, possibly as we move through the end of this year.
James, we often talk about neutral, where neutral is, what's restrictive. How useful is that conversation?
Well, I mean, we have to play the game because the central banks like to play the game. But in terms of an economic concept and the quality of it, the usefulness of it, I would throw it out. I mean, Jerome Powell tried to throw it out. If you go back to the hiking cycle in 2017-18, he told us to get rid of the stars, get rid of these nebulous concepts which are poorly defined and impossible to understand. But because they weren't going to guide policy. Now, that didn't end particularly well at that point, but it occurs to me that the last 4 or 5 Fed hiking cycles, it has never been the US economy's speed limit which has got in the way. Something has broken in the financial system or in the global economy a lot sooner than anything has broken in the US economy. So to the extent that a neutral rate is a useful concept, there's probably a different neutral rate for various of the aspects which are affected by Fed policy, and quite often that speed limit is slower in the global economy or global financial system than it is in the US economy.
Is something breaking now, and do we have a market functioning issue? Priya, I want to return to that point that you made about liquidity in the Treasury market. We understand on the latest reporting in the last hour or so that the US Treasury Department's quarterly survey of primary dealers has asked for the views on the merits and limitations of a buyback programme for Treasury securities. Now, Priya, you and I both know this is not QE. I think some people have run away with the idea that it might be QE. It's not. Priya, just run me through what you think needs to happen here and how you would respond to that question.
Sure. So I would say it's absolutely not QE. It's not monetary policy. It's something the issuer, the US Treasury, if they see dislocations in the market, as they are trying to fund the deficit at the lowest cost for the taxpayer, can they buy some cheaper bonds and issue richer bonds? That's essentially what they're trying to do. It's trying to restore market functioning in an environment where dealers are constrained because of high capital requirements on dealers. I don't think the dealer situation is changing, not unless there's any capital changes. So this is the US Treasury saying, should we, and they've just posed the question. It's not out there. I remember when they had the buyback program in 2000, that was actually because the deficit was shrinking. This would actually have to be a program where they're going to switch an issue with another issue or maybe issue bills. I think it's a great idea, particularly as a backstop, if in case there is forced liquidations. And we just saw what happened in the UK. If there is selling that has to come from some investor base, who's the marginal buyer of treasuries? It's a question we've been debating for the last few months. And it's not the dealers that can't warehouse this. So at least the US Treasury provides that backstop, much easier for the Treasury than if the Fed had to pull a Bank of England step and come in and start buying. Well, it's very hard to distinguish that from QE. But this is the US Treasury saying, can we restore market function? Can we be the marginal buyer of the cheap bonds, not of US Treasuries as a whole?
Priya, do you think that would improve liquidity? And would that have to be done in a predictable manner? At a set time, at a set place, and a set amount, or just done ad hoc? How would you execute it?
Yeah, so I think the devil is in the details. How do they exit? I would say a more regular backstop window that exists, and that they offset it not by issuing more 20-year bonds, because there isn't enough demand for that 20-year. Issue more bills. There's a scarcity of paper in the front end. And if they were to keep a big window, like the Bank of England had this window for 2 weeks, have a window for a while, come in when you need to buy the cheap issues, be clear on at what time of the day. I think as much predictability that they can provide, but keep a window open and offset it with bill supply. That's the way I would structure it. I think it's all going to depend on, do they announce it? When does it happen? I mean, it's a big lift for Treasury, for dealers. If it happens 2 years from now, it's too late. So, can they fast track this? And then how do they implement it? I think that it's going to matter. I think it has potential for improving market functioning. Is this a panacea? It's not. I think they have to do something with dealer liquidity. Dealer intermediation is constrained, but it certainly helps at the margin. And I think it takes the tail risk away. That if there is forced liquidations, where should that treasury rate be in? Who's the backstop? There's no Fed that's coming to the rescue like it did in March 2020. I think this is just removing that tail risk.
George, do we have a market functioning issue, and is it something we need to address?
Yeah, I mean, as Priya mentioned, clarity is really important, and so is predictability. And so there's a very clear distinction between the market functioning and monetary policy, and that's precisely what the Bank of England tried to achieve or is trying to achieve, and what the Fed may need to implement. And so liquidity is tight. We know that. It's an over-the-counter market. It's still an over-the-counter market. Liquidity ebbs and flows. We also have seasonal issues as well. And given the size of the market, considerable liquidity needs to exist to facilitate kind of these orderly transfers of risk. But it's very, very important to make sure there's a clear delineation between policy, trying to move the economy up and down, and an orderly functioning market. A little bit of predictability and a little bit of clarity would help the market sort of restore some of the liquidity. The Fed should not be trying to establish a price floor. The Fed is actually just simply trying to kind of sort of facilitate the transfer of risk. And that is the best thing they can do. The last point I'd make is that they need to sort of be in a position to do it when necessary. Preemptive may not be the best course of action. They may need to wait until something breaks, but being prepared and ready and willing and able to sort of facilitate that orderly transfer, that will be critical.
James, whose role do you think it is to fix this? If we've got a problem, whose job is it to fix it?
Yeah, I mean, that's a good question, John. I mean, I'd question whether we do have a problem as we sit here today in the Treasury market. The fact that bonds are less liquid, I don't think, marginally so really, I don't think that in and of itself isn't an imminent danger. As Priya said, you've got regulation which does very much constrain balance sheet usage, particularly amongst primary dealers, and year end is not that far away, and that brings with it caution amongst the banking and primary dealer community, which probably makes them less willing as well. We've also just had a huge amount of one-way flow. It's no surprise that dealers don't want to bid aggressively on bonds that they can't find anybody to sell them onto, because it's been such a deluge of selling as the Fed has gone through the gears. But in my opinion, we just need to be so careful. It's understandable in times of absolute extreme that authorities want to step in and ensure market function, and in extreme times, that is the right course of action. But these actions do have longer term consequences in terms of moral hazard, in terms of investor behavior when they believe that they can take on a little bit more leverage or a little bit more risk, because if things go wrong, there will be somebody willing to take them out of that risk at a reasonable price.
Hey, James, you're going to stick with us. James Athey, George Bory, Priya Misra. Coming up on the programme, another volatile week in the UK. A fiscal U-turn driving historic moves in the gilt market. That conversation up next.
We need to act now to reassure the markets of our fiscal discipline. I have therefore decided to keep the increase in corporation tax that was planned by the previous government. I have asked Jeremy Hunt to become the new Chancellor. He will deliver the medium-term fiscal plan at the end of this month. I want to be honest, this is difficult, but we will get through this storm, and we will deliver the strong and sustained growth.
Are you reassured? The Prime Minister's 8-minute news conference failing to convince many. MUFG's Derek Halpenny saying the UK is already in recession.
The non-bank area of the financial markets is obviously where there has been most concern. The terminal rate for policy has gone to 6%, which is a clear reflection of the panic in the markets in terms of the policies that were espoused by Liz Truss. We are probably in contraction territory as we speak, and that is consistent with financial market dislocation, problems, recession. Recession, we're already there, basically.
James Athey, you're living it. Just how much does this Bank of England need to do at its next meeting?
I mean, it's dragged its feet so long. It's kind of allowed this situation to be much worse than it needed to be. But you're right, it needs to get some grip on the situation. The market was priced for 100 plus 110 or 115 for the next two meetings not long ago. I don't think the bank is going to deliver hikes of that magnitude. The problem, and this has been the problem again for most of the year, is that we're really not getting much in the way of communication, certainly not any consistent communication. The Fed's communication strategy has been, A star relative to the Bank of England's, which is definitely an F.
Hey, James, that's a
so
low
it's
bar.
really difficult for us as investors to know.
That's what it takes to make the Fed look good.
That's
Compare
true.
it to the Bank of England in the UK in the last couple of weeks. Priya, the question we've been asking is you can lose credibility really quickly. It takes a long time to rebuild it. Many people have said the same thing. My question of the week really is, even though this is somewhat of a reversal, yes, you've changed the Chancellor, but you haven't done a full 180 on the package you unveiled a number of weeks ago. Given the experience of the last month, just how much scarring do you expect it to be on sterling assets?
Oh, I think a lot. I think there's permanent damage has been done here. I mean, look at the flip-flop in policy. Market liquidity was already challenged. I think they'll be rethinking of sterling as an asset to invest, any sterling asset to invest. I think there'll be a rethinking of the LDI model, which, we would highlight as it was well managed because they did all the stress testing. Well, they're not stress testing, I guess, 200 basis points in 2 days. So I think there is absolutely permanent damage done. But we're not even out of the woods yet because, it's a long time but till October 31st. I don't know if the market's going to give the government even 2 weeks until we get that medium-term plan, because the Bank of England has stepped away. We were hoping for some sort of an envelope to stay next couple of weeks. It's not. And so come Monday, if the LDI community and the rest of the market is still under deleveraging pressure, which I think they will be, then I think the question is, what more can the government do? Can they quicken that? Instead of October 31st, can we get that next Tuesday, the medium-term plan? I think we need certainty on that, even before the Bank of England. And I would imagine the Bank of England needs that. We need more from the government. What we got today was already in the price. That's why the market reversed it.
Yep.
So there's near-term problem. But yeah, I think there's a lot, even if they fully reverse everything and the government falls and we get a new head of the government, I think there's been a lot of damage that's been done institutionally to the country's assets in general.
Priya, how's QT going to work at the end of the month at the Bank of England?
Exactly, which is why I think if we are waiting for October 31st, I think the Bank of England has to push out QT. I mean, we thought QT was priced in, but not now. I think it's not priced in. In fact, I'm struggling to see how the gilt market even stabilizes without the Bank of England next week. So my thought is that we're going to get something between now and October 31st. And so maybe QT exists, but we would have had more details from the government as to are they sticking to every other part of it, or are there more U-turns coming? So, yeah, I think QT is another big stress point on that October 31st. So, but let's see. There's a long time between now and then.
I think a week's a long time. It's 2 weeks away, and that feels like a lifetime away. George, something happened this week that hasn't happened for me. I can't remember this happening for a long time. I think the last time this happened for me was when the Italian bond market really collapsed and it pushed Berlusconi out of power. George, it looks like the bond vigilantes are back. Would you agree with that? And is this what the post-QE world is going to look like? Is this difficult transition that we all need to get used to?
Well, the bond vigilantes do seem to be back, but more importantly, the backstops are gone. And I think it's, there's certainly an upsurge of selling. Now, much of what we've seen has been forced selling. I think the central message for us is sort of twofold. Number one, fiscal policy matters, and that came through kind of loud and clear over the last couple of weeks. And the central banks themselves can provide some degree of a buffer, but really that buffer is, at best, they can kind of facilitate somewhat of an orderly sort of market. And so, when we sort of look at, what is the bondholder doing here? Yes, there is certainly, a bondholder is going to vote against a poor fiscal policy, on top of the fact that that's going to put significant pressure on that domestic system because, as we've just discussed, liquidity is thin, the backstops have been removed, and importantly, whether it's the Bank of England, the Fed, or other central banks, trying to delineate the difference between orderly markets and monetary policy is rapidly becoming critically important. They want to sort of avoid kind of the moral hazards of letting the market expect a bailout. This is not a bailout. Sadly, the tools you use to facilitate both are the same, so it's easily to confuse But that should not be the assumption. The bond market is telling a government, telling a country whether it votes for it or votes against it. And markets are going to have to, governments are going to have to listen.
That's the challenge. George Bory, James Athey, Priya Misra, sticking with us. I've said this the last couple of weeks. My guests have said it too. How do you price risk when we can't price the risk-free asset? We're struggling to do that at the moment. Gilts, treasuries, take your pick. Coming up, still ahead, the final spread the week ahead, featuring more bank earnings and another busy slate of Fed speak. That conversation coming up next. Live from New York City, I'm Jonathan Ferro. This is Bloomberg Real Yield. It's time now for the final spread the week ahead. Coming up in the week ahead, the Bank of England governor will be speaking on Saturday. Put that one in the diary. He spoke a couple of days ago. He said you've got 3 days. We thought he was speaking to the pension fund community, not the government. Turns out it was the latter, perhaps not the former. You get some more Fed speak through the week. Kashkari, Bullard, Evans. Then you get some bank earnings. Bank of America on Monday, Goldman on Tuesday. Plus, we get an RBA rate decision, the Fed beige book, Eurozone CPI on Wednesday, and finally, another round of jobless claims on Thursday too. Let's round things out on this programme with a rapid-fire round. 3 quick questions, 3 quick answers. Priya Misra, first to you. Is November's 75 basis point hike the last 75 of this cycle? I've asked that a few times. Your answer now, yes or no?
Yes.
James?
No.
George?
Yes.
Next question, peak Fed funds. You can pick a number, but I'll offer you 2 options. 4 handle or a 5? James?
5.
George?
4.
Priya?
5.
Here's my question of the moment. QT. Does QT make it to 2023? Does Fed QT make it into 2023? It's a yes or no. George?
It's a great question. Yes, we think it does.
Priya?
It does, but not all year, because I think the Fed will be easing mid 2023, and then they'll have to stop QT.
And just quickly, James Athey, yes or no?
Yes, just.
To the 3 of you, thank you. What a week for us all. Priya Misra, James Athey, George Bory from New York City for Real Yield. Same time, same place, different person next week. This was Bloomberg Real Yield. This is Bloomberg.